Imagine for a moment you're standing in a giant supermarket. It's not a normal supermarket. Instead of food or drink, every aisle is filled with different companies. Apple over in aisle 1, Tesla in aisle 2, Coca-Cola in aisle 3, and thousands of others stretching as far as the eye can see. Now you're told, go pick the best companies you think will make you money in the future. You grab your basket and start walking, but then it hits you. How do you know which companies will be the winners? What if the ones you pick fail? And what if you miss the next big thing? This is the challenge individual investors face every day. Picking stocks can be exciting, but it's risky, time-consuming, and statistically, most people who try it don't actually beat the market over the long run. That's where index funds come in. In this video, we're going to cover what they are and why people use them. Please do subscribe if you haven't already. It really helps this small channel grow. At its core, an index fund is simply a type of investment that tries to match the performance of a whole market index. Instead of you running around the supermarket picking stocks yourself, the index fund comes along and says, don't worry, I'll just take a little bit of everything in the same proportion as the market itself. For example, in the US, one of the most famous indexes is the S&P 500. This is a list of the 500 largest publicly traded companies in America, ranked by size. An index fund that tracks the S&P 500 will go out and buy all 500 of those companies in the same weights they appear in the index, so your investment automatically rises and falls with the market. To understand why this matters, we need to talk about two styles of investing. Active investing is when fund managers or you try to pick the best stocks, time the market, and beat average returns. Passive investing, which index funds are a part of, doesn't try to beat the market. Instead, it just tries to be the market. And here's the surprising thing. Over the last few decades, study after study has shown that most active fund managers, even highly paid professionals, fail to beat their benchmark index after fees. So rather than paying a fund manager to try, index funds just copy the index cheaply, meaning lower costs and fewer mistakes. Let's say you put £1,000 into an index fund tracking the FTSE 100, which is the UK's 100 largest companies. Your money is split across all 100 companies according to their size. If a big company like Shell makes up 8% of the index, then 8% of your money goes into Shell shares. If a smaller company like Ocado makes up 0.5% of the index, that's all you own in Ocado. As the value of these companies change, the index changes, and so does the value of your fund. If a company grows enough to join the index, your fund automatically buys it. If a company shrinks or goes bankrupt, your fund sells it. It's constantly adjusting behind the scenes to stay perfectly aligned with the index it's tracking. One of the biggest strengths of index funds is diversification, which is a fancy way of saying don't put all your eggs in one basket. If you own shares in just one company and it tanks, you could lose everything. But if you own a tiny slice of hundreds or even thousands of companies, one disaster won't sink your whole portfolio. We can think of it like a football team. If one player gets injured, the match doesn't stop. The rest of the team keeps playing. An index fund is like owning the whole league. Even if one team does badly, the others can carry the season. A big reason index funds are so popular is cost. Because they're just copying a list of companies from an index, there's no need to pay analysts to research stocks or traders to constantly buy and sell. This means the annual fees, sometimes known as the expense ratio, are much lower than actively managed funds. For example, an actively managed fund might charge 1% of your investment every year. That might not sound like much, but over decades it can eat away a huge chunk of your returns. In contrast, some index funds can charge as little as 0.05% per year. On a £10,000 portfolio, that's just £5 per year in fees. Here's why those lower fees are such a big deal. Imagine you invest £10,000 or dollars for 30 years and the market grows by 7% a year. With a 1% annual fee, you'd end up with about $19,000 less than if you'd invested in a low-cost index fund. That's the power of compounding. Fees compound against you just like returns compound for you. Not all index funds track the same thing. The most common are stock market index funds, like the S&P 500 or FTSE 100. But there are also index funds for global markets, tracking thousands of companies worldwide. There are also funds for bonds, which track government or corporate debt markets, other funds for specific sectors like technology, healthcare or energy, and even some index funds that focus on dividends, buying companies with high and stable payouts. That means you can build a whole investment portfolio using just a handful of index funds, or perhaps even one if you wanted to, covering everything from US stocks to emerging markets to bonds. One thing to mention is you'll often hear people mention ETFs, exchange traded funds, in the same breath as index funds. They're similar and often overlap. An ETF can be an index fund, but not all ETFs are index funds. The main difference is that ETFs trade on the stock market like normal shares, so you can buy and sell them throughout the day, but they usually come with slightly higher fees. Traditional index funds are priced just once a day. In practice, for most long-term investors, both work in a very similar way. Of course, as with any investment, index funds aren't perfect. Let's look at some of the drawbacks. First, they guarantee you'll get market returns. No more, no less. If the market crashes, so will your index fund. There's no protection built in. Second, because index funds invest in companies automatically, they might include businesses you don't personally support, such as tobacco companies, oil producers, or controversial weapons manufacturers. Some ethical or ESG index funds try to filter these out, but you'll need to choose carefully. Another drawback is that index funds can create a bit of a herd effect. Since everyone in the fund owns the same companies in the same proportion, it can amplify big market moves up or down. So how do you actually buy into an index fund? If you want to buy into one, you typically go through a brokerage account or investment platform. In the UK and US, you might use Vanguard, Fidelity, Hargreaves Lansdown, eToro, Robinhood, or many others. You choose the fund that tracks the market you want. For example, Vanguard Global All Cap Index Fund or iShares Core S&P 500, and invest your money. You can start with a lump sum or set up monthly contributions. Over time, you simply leave it alone and let it grow. That's one of the main draws of index funds. They don't require constant monitoring or trading. One of the biggest mistakes new investors make is trying to time the market, jumping in and out based on headlines, predictions, or gut feelings. The issue with that is that nobody can do it consistently, not even highly paid professionals. Index fund investors often take the opposite approach. They invest regularly regardless of whether the market is up or down, a strategy known as dollar cost averaging or pound cost averaging in the UK. This smooths out the price you pay for shares over time and removes the stress of trying to predict the future. Over the last century, major stock market indexes have tended to rise over time, despite wars, recessions, pandemics, and political instability. That's because indexes represent the collective growth of businesses, innovation, and the global economy. There are dips, sometimes big ones, but historically, patient investors who stick with broad market index funds for decades have been rewarded. Have you ever invested in an index fund, and do you believe it to be better than individual stock picking? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching. Why not consider watching this video next? If you have an interest in technology as well as finance, I've left a link to my other channel down in the description. I've also left a link to my investment platform of choice if you're in the UK down in the description. I will earn a small commission if you sign up using this link at no extra cost to you.